Greetings. This is Kim Wilson from the Fletcher School, and this is a short lecture on de-risking and its implications for financial inclusion. Here's a quote for you. The ironic result of de-risking is re-risking. You are sending them to banks that probably can't handle it. And this comes from one of our readings by James Richards from Wells Fargo. So let's start with a few definitions, and these have been adapted from the 2011 GPFI white paper. Financial inclusion refers to a state in which all working age adults have effective access to the following financial services provided by formal institutions: credit, savings, payments, insurance, and investments. However, formal products and providers do not in all cases offer customers better value than informal products and providers, as may be indicated where there is access but limited or no usage by financially excluded and underserved customers. All that's to say that finally GPI is waking up to the idea that formal services are great, but sometimes informal services can step in nicely. Digital financial inclusion. Here's the definition from the 2016 GPFI white paper. Digital financial inclusion refers broadly to the use of digital financial services to advance financial inclusion. It involves the deployment of digital means to reach financially excluded and underserved populations with a range of formal services, financial services suited to their needs, delivered responsibly at a cost affordable to customers and sustainable for providers. So I think those are two pretty good working definitions. We at Fletcher support those. So with that in mind, let us move on. What are the risks of digital financial inclusion? Well, digital financial inclusion presents new or shifting operational settlement, liquidity, credit, consumer, and anti-money laundering, corruption, fraud, and terrorism risks. So here are just a few of them. There's new providers and new combinations of providers. That means regulators may have to work together because telcos are combining with banks and with other third parties in ways that are helpful to the consumer but challenging for policy. Digital technology itself opens itself up into a host of issues, not the least which is privacy, data privacy, and the fraud and theft that can come along with digital technology. Use of agents is new in digital financial services. Agents have been used in a variety of different kinds of financial schemes, but using agents in financial services that are not necessarily trained with a financial background. They maybe have more of a telco background. This presents challenges. And of course, how new products and services are bundled and aggregated makes a difference in how they're regulated, also presenting risks. So who are the standard setting bodies and what are their agendas vis-a-vis financial inclusion? Well, you have the Financial Stability Board, and then you have 6 other global standard setting bodies that touch on financial inclusion. We have the Basel Committee on Banking Supervision, the Committee on Payments and Market Infrastructure, the Financial Action Task Force, the International Association of Deposit Insurers, the International Association of Insurance Supervisors, and the International Organization of Securities Commissions. So all these together create standards of operation and policy for institutions and jurisdictions in the world of financial inclusion. These standard-setting bodies concern themselves primarily with financial stability and soundness of an entire financial system, integrity, meaning anti-corruption, fraud, and terrorism, and consumer protection. More recently, these standard-setting bodies have been persuaded to take financial inclusion very seriously as something that each one of them should take up as part of its own agenda. Now, what's happened recently is we've seen a global phenomenon in something called de-risking. De-risking refers to financial institutions closing the accounts of clients who they perceive are high risk for money laundering or terrorist financing, namely money services businesses like remittances businesses, nonprofit organizations, correspondent banks, and foreign embassies. Now, here's a table. Don't pay too closely attention to it, but you see our standard setting bodies listed horizontally. And here are some of the risks that they see in digital financial inclusion, and some more so and some less so. So let's look at the bottom one here, consumer protection. Triggered by new providers, agents, and profile of excluded, underserved customers. Yes, they see consumer protection as a big risk, that we all have to do more about it. And then this next one shows that they all think, every single one, you can see all the X's here, that money laundering and terrorist financing risk, including financial exclusion risk of overcompliance, triggered by inability or reluctance of regulators or financial institutions to apply risk-based approaches to their institutions. And this is a word we hear a lot about, risk-based approaches, RBA it's called. And while this is very important to do, take into account how much a risk is a particular client, and then how far do we have to regulate them and monitor, is the question that goes with that. But it's something, as an industry, we haven't gotten very good at yet. Over compliance seems to be the knee-jerk reaction to a risk-based approach. Okay, so what are some of the drivers of de-risking? Well, to begin with, a lot of these financial institutions, banks, see low-income clients as not profitable to begin with. So right out of the box, they don't see these clients as bringing about a lot of profit. Then there are the fuzzy risk-based approach guidelines. So they're out there, but they're not clear. There's increased compliance costs and pressures that are being put on these financial institutions, and of course, that drives up their costs. There's rising fines for non-compliance, more so than a few years ago. There's reputational risks. This came across very clearly with Barclays Bank when it pulled out of Somalia. It did not want to be seen as being involved with any kind of shadow banking efforts. There's increased corporate and individual accountability risk. So in the past, it was the corporation who took all the risks, but now if somebody's found culpable, individuals within that institution can be named and fined. Therefore, if you put all this together, banks have little incentive other than corporate social responsibility to bank low-income customers. In fact, just the opposite. So what are some of the causes and consequences of de-risking? Well, first you have stringent AML-CFT, which as we know is anti-money laundering, corruption, fraud, and terrorism policies. They're getting more and more stringent. We have increased cost of compliance for formal institution. And then that has led to, so stringent AML plus increased cost of compliance has led to account closings by the formal sector. They're closing those small bank accounts held by low-income customers. That has led low-income clients to drive underground into the informal and non-digital sector. That has pushed these debanked people into cash systems. And that has led to low quality or no services for some debanked. So yes, they're in cash systems, they may be getting some services and maybe some very good services. But for example, they're not able to avail some of these long distance remittance services that constitute their livelihood. So people living in Somalia that were expecting money from the UK cannot access that anymore. And bringing cash that distance is simply not an option. So they have to forego. So what does that leave us with? Well, that leaves us with, you add up all these factors, and that leads us to financial exclusion. So debanked people move into cash systems. That means low quality or no services, which leads to financial exclusion. And authorities lose the opportunity to trace fraud. When you go into a cash system, people become less traceable. And that produces systemic risk. So you have financial inclusion risk and systemic risk. So that means this over-stringent AML-CFT activities mean that all parties lose. None of the agendas of any party is fulfilled in this scenario. So let's review the consequences. De-risking clients moves them into shadow banking. Regulators lose the chance to monitor them once they go into the world of cash, and that means there is systemic risk. There's also reduced correspondent banks. That's been another phenomenon of de-risking, reduced correspondent banks. And let me just read you a bit here about what that can mean. Correspondent banking relationships are the connective tissue linking various points across the global financial system, offering foreign banks access to U.S. and European financial markets and, more importantly, foreign currency. This is important for emerging markets as the majority of the world's cross-border capital flows, including commodity markets and trade finance, are conducted in U.S. dollars. The U.S. dollar is used for 44.6% of all world payments. So this means reduced correspondent bankings, reduced access to that kind of capital and to those markets. So trade finance opportunity decreases, access to foreign currency decreases, and then thus trade itself decreases. You can see this, the logical if-then framework developing here. Reduced correspondent banks mean humanitarian agencies cannot access their own accounts, and therefore it slows or even in some cases stops the flow of aid. And no access to crucial remittances, with no correspondent banks playing in this key part of the financial value chain. That means remittances going back and forth to these countries stop. And so what does that mean? What's the bigger implication picture here? Well, as we discussed in the previous slide, financial inclusion, increased threat of crime, because as people go underground into the cash system, there's more opportunity to hide nefarious activities. National poverty, if we're talking about reduced correspondent banking leading to reduced trade, we can talk about national poverty. And of course, humanitarian crises. So this deadly brew triggered by overcompliance with AML-CTF can lead to all kinds of nasty consequences. So Oxfam's recommendations are as follows, and you can see this on page 31 and 32 of the report that we assigned you. The authors offer a host of thoughtful recommendations. One of them is, explore the adoption of non-traditional identification policies to alleviate a primary obstacle to financial inclusion for vulnerable communities. For instance, biometric print, clan elder physical identification, and so on and so forth. So with that in mind, here are some questions I would like us all to consider. What government or non-traditional identification policies innovations have you either seen work in your jurisdictions, or what policies might work if given a try? So how can we be creative about ID in such a way that the supply side and the regulators get their needs met? We can verify a person, but the demand side, the people that must come up with the ID in order to use the services, aren't overly burdened. What might be areas of harm that could result in such policies? So it's great to be able to identify people, but what damage can be caused because of that identification? And what benefits might result with government or non-traditional identification policies and innovations? So that's all. I thank you very much and look forward to the discussion this week.